In this video, we're going to talk about negative amortization. Negative amortization is something that happens with loans. So it's when you borrow money, and if for some reason your monthly payment is less than the interest that you accrued for that month or for that period, then you're actually going to have a situation where your loan balance, right, the amount due, the principal, is actually going to increase. Right? And the reason is that some of this interest is being capitalized to the loan balance. So let's just think of it like this. If you incur, let's say you have it could be a student loan. Let's just say you have a student loan. And so you incur $500 of interest during the period. So you incur $500 in interest, but but the payment that you make is only $200. Well, your payment didn't even cover the interest that was due. So you've got $300 difference here. Right? You've got a $300 difference, and what's going to happen is that however much, let's say your original balance, you owed $40,000, now you're going to add that $300 and you're going to owe $40,300. And so we call it negative amortization because normally when you have a loan, you're amortizing or paying down the balance. You're paying down the balance till it gets to zero, right? Negative amortization, it's actually a situation where the balance is increasing. So I'll just walk through an example. Might make it a little easier for you to understand. Let's say that you had a 30-year loan you borrowed $185,000 and you got charged an interest rate of 5.25%. So the payment that would be required to amortize that loan would be $1,022 a month. It's just rounded. And so of that first payment, that very first payment that you make, $810 would go toward interest, and $212 would go toward the principal. And so what would happen is then your loan balance would decrease at the end of that month. So your loan balance would go to $184,788. Why is that? Well, your payment paid the interest and it paid some of that loan balance. So now your loan balance has been reduced. But what if we had a situation where the payment was not $1,022, but it was instead something like $500? So let's cross this out here. I'll change colors to make this clear. So let's say your payment was $500. Well, nothing else has changed in terms of like the interest rate and the amount of loan. So you're still going to incur $810 interest in that period. But this time you only made a payment of $500. So the lender's first going to apply that toward the interest. So what happens? You don't get to pay down any principal, right? The principal that you pay down is zero. Matter of fact, you didn't even cover all the interest. So you've got a difference here of $310 shortfall, right? So you're $310 short on interest. That means you incurred $810, but you only paid $500 of it. So the lender's not just going to forget about that interest, right? So what's going to happen? That $310 is going to get tacked on. So I'll put here tacked on to the principal. They call that capitalized to the balance or capitalized to the principal. So now your loan balance has gone up. It's gone from $185,000 to $185,310. And this process here, now the loan balance has actually grown larger. That's what we call negative amortization. And when there's a loan that does this, sometimes you'll hear people call it, for slang, they'll call it a neg-am. Neg-am. So if they're talking about neg-ams, they're talking about negative amortization loans. Now you might say this is silly. Why would there ever be a loan that's constructed where the balance is actually growing larger? Well, in some cases, obviously, if you just can't make the payment and you work out some kind of thing with your lender, in the short run, you might think, well, maybe that's a reason. But sometimes loans are specifically designed to do this. And you might think that's insane, but actually there's some logic to it. I'm not saying that it's always a good idea when someone has a loan with negative amortization. But, for example, if you have like an ARM loan, an adjustable rate mortgage, or if you have a graduated payment mortgage, right? A graduated payment mortgage, both of these types of mortgages, you might be in a situation where in the early years, so let's say early periods of a loan, early periods, you have a smaller mortgage payment. Smaller payment. Why? Because maybe you have less income during this period. So you have less income. So they say, you know what? right now you just had a child, you've got some expenses, but in the next few years, we see that you're going to have more income, right? So we think that you're going to have more income, and so we'll give you this graduated payment mortgage where even though you've got for the first few years your loan balance is actually increasing, it's actually because your payment isn't sufficient to cover the interest. Well, that's going to help you get into a house now, and then when you have higher income, 3, 4, 5 years from now, the payment is going to be higher. So that's why we call it a graduated payment. So your mortgage payments, the first 2, 3 years of the loan might be low, so low that you're not even covering the interest. But hey, you get to live in a home, and that's the home you wanted. And then 4 or 5 years from then, when you can afford a higher payment, then your loan would step up in terms of the payment. But what if there's some kind of situation where you don't get that increase in income that you thought you were going to get, but then the higher payments come, and at that point you've actually been increasing your loan balance. So a lot of people see this as a very risky thing, and actually in some cases a bad thing when you have negative amortization, because the whole idea in theory with a loan is that you would like to think that every payment you make, there's some amount that's going toward the principal. And when you have nothing going toward the principal, or you're not even covering your interest, it can be kind of a depressing thought. Although, like I said, there are situations where it might be acceptable, or the thing